I want to take into the lower time frames and talk about this area between the blue shaded buy side unbalanced sell side efficiency and this buy side unbalanced sell side efficiency. Okay, so both are suspension blocks, and that little space in between, right in here. Okay, so let's go down into a 1 minute chart. We're going to look at the open at 9:30, right in here, and the 9:30 opening is right here. Okay, so that's the opening price. We opened in the lower portion of the space between this daily suspension block low, that shaded area in blue, and the high of the lower daily suspension block. So again, rewind the video a little bit and look at the daily chart again. This and this, those are those two respective shaded areas on the daily chart. Okay. Now we had relative equal lows in here at open, and we opened just above that short term high. Notice that? So what did they do first? They opened at 9:30 open above this short term high. So we opened above where buy side liquidity would be, and then a little bit of a flurry higher, and then all in 1 minute it drops down here, and then we have relative equal lows right there. And then a few minutes later on 9:33, the market trades for the sell side. Now, when there is a expected direction, now I obviously shared my bias this morning. I told you where I thought I was going to go, and that being up here. Okay, so when it does that, it gives you a space between two inefficiencies, like on a daily chart or a 4 hour chart or an hourly chart. It's real easy to forecast and predict. And I'm going to say that again. We don't react to price. Okay. So the opening price above here, the buy side's taken first. Then they come back for this. But it's occurring inside this little spatial area in white. Now, you can predict how price will move when it's moving from one area of inefficiency that's been traded back and forth. In other words, we went down and up in the lower gray daily suspension block. We went down there in FOMC and then we came right back up all through last night. And I'll zoom out in a minute, but for now, I just want you to understand the logic. We trap traders buying above here, trying to catch a continuation. Where do you think their stop loss is going to be placed? Right below these relative equal lows. Then the market dives down, knocks them out. And now this right here, I'm measuring and grading this wick. See what I'm doing here with this fib? When it creates this wick and it does a stop hunt, this right here is a very clear depiction of the market saying, I'm not going any lower. And you're watching that midpoint level right there. Okay. What I'm measuring is the high, which is the close of this candle, and the low, that wick. And this, it can't even come down and touch that. Now, as I teach order flow, visually represented in the candlesticks, is this bullish or bearish? It's bullish, and the market trades higher. We're not looking at the fact that it's trading above this previous candle and saying that's an engulfing candle. That's after I already determined what I taught you to determine when it's going to turn down here. Okay. Everybody else's school of thought is wait for the breakout, be confirmed by the breakout, chase the momentum. I don't want to do that at all. Knowing where these wicks will stop, when it's opening here and going down, and you're anticipating, as I teach you, when it's bullish, what do we want to see? The upper half. Okay, the upper half's going to support the narrative. We can wick down through it, but the body, and preferably not even touch the halfway point, because that's indicative of bullishness. Then the market then trades and goes above the previous candle. Then everybody else will call that an engulfing candle. But I'm already focusing down here at the low. It's a repeating phenomenon. When you know what you're looking for, it will give you such a high degree of front row VIP seating in trading. But it's scary in the beginning. I understand it's normal for you to feel that way. But Here, it fails to go down to consequent encroachment of this discount wick when the market has taken sell side and tripped buy side first. We have the market take out this short-term high here, and then we start getting all these wicks. And what's actually happening is this body is the order block. So the algorithm is reaching into this opening price here, down to the body. The longest wick, notice it goes longer than there on the downside. This one and this one. This one sets the tone for where the bodies should not trade below. We open, trade down into the order block, and we send it higher. And then we get a little bit of wick. Why is this important? It's not, because it hasn't breached the midpoint of this one. The next one here, this one goes lower than this one, and it also goes lower. Let me say it again. This wick goes lower than this wick's consequent encroachment, but it also pierces its low right there. So this is the lowest one. So this wick, we don't get any bodies going below that. You notice that? But we're digging down into this order block. So we have multiple attempts to get down there to accumulate. That's what this is. Smart money is accumulating here. Notice what it's also trading into. It's the high of that lower buy side balance, sell side efficiencies suspension block. Don't forget that. You forgot about that gray area, didn't you? Because you're so worried about these individual candles. So you're blending several things here. There's a layering of discount arrays supporting the idea that this thing's about to go nuts straight up. We opened here, did all the business I just outlined here. Then, because we're inside this white shaded area between two daily inefficiencies, price, when it starts to go up, it's going to do so quickly, efficiently, running higher. It's going to go quickly to get to this area here and then drive right on up into that lower octant. Think about that. That's why price had all this clear pathway, and this is how you predict low resistance liquidity run conditions. How you can blend the narrative of why price should go up, how it should behave as it goes up. We don't want to see this kind of stuff going higher, slowly going higher, slowly going higher, slowly going higher. Now I can zoom out and show you what the difference in by contrast. See, we traded down into it here, and then we worked higher, and then once we broke this high, it went right into an efficient buy model, or buy program rather. What is that? It stays in very short little candle ranges, but just keeps building higher and higher. Trying to short this is murder. It's murder. It's death by 1,000 cuts. And it just keeps going higher and higher and higher and higher. And every one of these quadrants and octant levels build PD arrays, and it's supporting price going higher. And because it did this so efficiently, this is not a low resistance liquidity run condition. This is an efficiently delivered price action. It's this real tight, narrow channeled higher, 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 and you will murder yourself trying to short that. But now look what happens. Once we get to 9:30 opening right here, and we're outside of the control, my daily suspension block was controlling this efficiency going up. The fact that here we have the market opening in the open space between two daily charts that are separated with a space where there's no overlapping. This blue area and this gray area on the daily chart are very specific things that I teach you to focus on. How is it possible that the market reacts off of it like this and then behaves with this real clean price action run? Low resistance, that means it's big candles, speed, it's got everything you want. And wouldn't you know it, it just races right on into that level. Straight from here, we have 10 candles in a row. Just for 10 minutes, it just screams up there. So once we got into this area, then you're going to start looking at the octants and quadrants of the higher buy side balance, sell side efficiency. We have this level here that's anchored to the lower octant. When price trades back down, that is a valid bullish fair value gap. Then this opening price, I'm not going to draw it on here, but you can see it. That's the change in state delivery. Draw that over. Okay, you can see them dipping down into the order block. Look at the bodies. The bodies are not violating the halfway point or mean threshold of this. Just see the blue in here? No bodies are doing anything near that. So it's validating this as a what? An ideal valid ICT bullish order block within a bullish fair value gap anchored to the lower octant. So you have several things there. And even the fair value gap, look at the bodies. They're staying in the upper half. That's order flow. And it's occurring during 950 to 1010 macro. What's the lowest candle here? 1010. So we have a big wick here that drops back down in here. And that big long wick, we want to measure that because it's standing out against this and this. These two candlestick wicks, and then this big prominent one. As soon as that candle closes, we're waiting for it to trade back down into half of that. And if we're bullish, we do not want to see the body breach it. Does the body breach it? No. Does it wick through a little bit? Sure it does. That's permissible. But how do you know? You have to trust it. You trust it. You trust your bias. You trust the narrative. You think price is going to keep going. There's a small little minor buy side liquidity pool up here. This is a buy signal right there. As it's opening and trading down, it doesn't feel like it when you're watching it. Nobody else on the internet is going to take that trade. But you see me doing it all the time. I'm adding and building, pyramiding, entering straight on it. You have seen it. And the market rallies up. And then we get this right here. Right in here. So we have the low of the daily suspension block, lowest octant, and then the lowest quadrant. This lowest quadrant has a candlestick that's attached to this right here, so it's anchored. This is a short little fractal of the time price grid. Okay? All these things in here are going to come together. Watch. We have the market leaving the macro at 1010. It's coming back and trading right back into this buy side unbalanced, sell side efficiency that's anchored to the lowest octant. That's at this level is here. And we have an order block that's also anchored to this octant. The market trades down into the same inefficiency, the same order block that's anchored to this lower octant on the daily bullish suspension block. That daily chart, the blue shaded area, that's what we're focusing on in here. We're in the lower end of that. So when we trade back down into this, this is not, oh, you're trading outside of the macro time. No, you're trading in sync with the macro that started this run here. Look at the bodies. Look at the bodies here. What is it telling you? What do I teach? The body should not touch the halfway point when it's bullish. The body should respect the upper half once we leave it. It's having a hard time getting back down in there. Then we have it trade up to the lower quadrant. Market trades back down, hits the same fair value gap and order block. And then we create a wick. Watch and see. It opens, trades down. We want to see it preferably fail to get there. Then it's really bullish. But here it opens, trades down. You can buy that. Stop loss below consequent encouragement. Why? Because you have this wick already anchoring that the logic should be it hits it and runs away. This open trading down in the upper half of that wick, that's the buy signal. That's the buy setup right there. You don't have to be in the macro. You just have to know what the macro should be putting in motion. Okay. And when you see that the time grid is this, watch. We have 950, 1050. See that? I told you I could trade every hour and strip it down to time and price there. Here it is. Here's your grid. These levels here. Okay, you see that? That is the grid aspect horizontally. Vertically, the vertical axis is the macro start time. So we have vertical, we have the beginning of the macro, and now divide the macro, top of the hour, right there. Okay. So now you have two primary functions. You're looking for a specific key level that's based on a octant or a quadrant level. You have to know what you're measuring and grading. It's an efficiency, it's an opening range gap, it's a new week opening gap, it's a new day opening gap. You're literally picking these very generic things I've told you to focus on. But these very generic things, in the hands of this type of application with them, it's untouchable. Now, jump forward. We have a beginning of a macro over here. So that will close the grid time wise. You can carry it over here and start the same thing I did here. But now watch what happens. Every single time we get to a octant or a quadrant level, you're looking for a PDA to form. Here, I've already outlined it in the order block. It's occurring at the octant inside the first portion of the macro. The second one, the lowest candle forms, look, the lowest one forms at the close of the macro. And you think that's random? You honestly believe that some lottery level feat of randomness is going to create the turning point that's the lowest one at the end of the macro time that I teach you? So we have horizontal and vertical reference points. And once we get to an octant or a quadrant, you have to know your bias. You have to know what you're looking for. Okay. So if you think that the market's likely to draw up above this high or draw down to the low of that daily suspension block, the low of that blue shaded area down here, if you think it's going to retrace back down to there, then you can go through the process of looking for things to time it. We have a quadrant here. Look what this is. That candlestick right there is a buy side imbalance, sell side efficiency. If we are not able to trade to the consequent correction midpoint, our perspective is skewed. And when you understand that these things like this candlestick forming right there on that octant before you get to consequent encouragement, that line right here, if we're going to see it move lower, because we've seen it pump straight out of the opening and we're up in here, and now look what it's doing. It's failing to get to that consequent encouragement level. And we're fast approaching. We're fast approaching what? A new macro, 1050. So you can look at this right here. We're at this lower quadrant. We have a little bit of a gap here too. And if we're expecting a failure because it can't go any higher, it's failing. Retail traders going to see this. Oh, it's a bull flag, bro. The market breaks down. And then once we get this close outside of it, outside of what? This buy side balance, sell side efficiency that is validated right here on this octant. Failure, breakdown, close outside of it. That validates this as an inversion fair value gap. Its first utilization is that of buy side delivery. In a bullish market, it would support it. But why isn't it doing it here? Sure. The bodies, the wick, okay, it trades down through it, but the bodies are up here. That looks good for a while. And then it fails to go any lower in here. It looks good, right? And then qualifying, it's now a bearish inversion fair value gap. Focus on the midpoint of it. The bodies need to stay out of the upper half. It can wick into it like it does right here. And if it does, you can short it just ahead of the macro. You don't have to take trades only in macro time. It's just a very sweet indication of time having an influence over price. Watch what happens now. We trade lower and then come right back up. I'm going to take this vertical line away, okay? It's the beginning of the new macro. Selling short here, inversion fair value gap, it breaks down, and we get into this gap here. If it's bullish, it should support price. And it doesn't. What's it doing? It's closing below that. When you understand the source code, you can see that, oh, it's telling me it's failing to go higher. This right here, I'm watching. I'm predicting that this is going to fail up here. It will not be a bull flag. Then it goes lower and it closes below it there. That right there is the little telltale sign, the little crack, the little black cat that just happens and deja vu appears. In the movie The Matrix, just to borrow that little analogy, whenever you see deja vu, that's them changing the matrix. There's something afoot. That's Phil. That's Phil. He's doing something there. He's disturbing it. But I'm here and I'm pointing and I'm following these yellow brick road paths. that cannot hide from you once you understand what it looks like. And right up in here, the logic is the body should not go in the upper half. It doesn't. It wicks. Short drops down and in here. Anticipate this becoming an inversion fair value gap. Trades down, closes below it, opens, trades up until here. Short. Short it. Why could you be confident there? Because look at this wick. We grade that. When it goes below there, any movement now when we're below it and trades up, this needs to turn into a wick and not be a body. And you watch me outline this stuff all the time. We trade below it, open, short it. Runs all the way down, just shy of getting into that low. And one more time, where's it trade back up to? The inversion fair value gap that you can predict. When it forms, it's ironic. It's almost mystical that the last candle is 10 minutes after 11. That's the close of my macro. So we get the inversion fair value gap here. The market starts to sell off. And look at that. It goes right down to the low of the daily suspension block. Isn't that crazy? It's wild, isn't it? And then the market has a little bit of reaction, goes right up into here. Now we can start anticipating another PDRA form. And then we have a wick here. And then you grade that. And if there's a body below it, that means we could probably go a little bit lower. And it does. And then we rally up. Now we have fair value gap. Wait a minute. Wait a minute, bro. It's not on a key level. How you going to call that a fair value gap? What do you mean it's not on a key level? What do you mean it's not on a key level, man? The low of that daily suspension block. That's the lowest portion line. That's a key level. That's where my PD rate is going to form. The market rallies up, creates a fair value gap, and then we trade down into it here. What is what? Institutional order flow entry drill. So back to this. This fair value gap is anchored to that low. This candlestick. There's candlestick number 1. Candlestick number 2 is the inefficiency. And candlestick number 3. This area here is the gap. This gap is valid because it's anchored with the number 2 candle that makes the inefficiency. That has to be touching an octant or a higher low of inefficiency or whatever range you're measuring and grading out. It's a key level. Market rallies up. Same bit of business here. We have this. Small little volume imbalance, small little volume imbalance, buy side imbalance, sell side inefficiency. Why is this a valid buy side imbalance, sell side inefficiency fair value gap in the form of a suspension block? Why? How's that? Because it's anchored to and it's touching that lower octant. Do you see a pattern here? Be thankful that you can see it now. Buy side imbalance, sell side inefficiency. Trades right down to the low, stops. That's random. Rallies up. Look where the bodies are. Where are they? Where the old man tells you. If it's bullish, it's going to be in the upper half. Here you go. And here you go. One more time, tap to the middle. You're telling me that buying and selling pressure stops it here, stops it here. The bodies are opening, closing. I'm telling you the logic where these candlesticks are going to start and begin. Rallies up and trades right back into that validated inversion fair value gap. It's there. It's going to trade up into this portion, all the way up into the lower half. It leaves relative equal highs here, the minor buy side. We're down here. We can anticipate what? It's going to probably try to get up to there. What is it going to be met with? There's going to be formidable resistance here. And it's short term, but it's only going down to accumulate there. Showing you signs it wants to go higher. It wants to go higher. Rally. Sells off, accumulates, runs through. Now this becomes, it reverts back to first utilization. Buy side imbalance, sell side inefficiency. In a bullish market, it'll support it. Rallies up. Inversion fair value gap. Trades up. If it's really an inversion fair value gap, it should do what? The bodies stay in the lower half. The wick can go to and just past all the way up to the high, but no bodies are allowed to be buried in the upper half. The lower half needs to tell you this story is still intact. And what happens? The market breaks lower. Back down into the lower quadrant. We have a nice little sell sign of balance, buy sign of efficiency here, trades up to it, and then right back down to what? The order block right there. This is intraday pinball. You've seen me do it. Inversion fair value gap trades down to the discount array. Do the bodies breach the consequent encroachment? The buy sign of balance, sell sign of efficiency here? No. Is that bullish or bearish? Bullish. Well, it snaps up. Then we get this buy side of balance, sell side of efficiency here. One single candle because it's anchored to the lowest octant. The market trades back down. Look, is it bullish or bearish? The wick goes down to consequent encroachment, just a little bit hair through it, but the bodies can't even touch the halfway point. Is that bullish or bearish based on the old man? It's bullish. Okay, the market rallies up. What's it doing? Trading right back up into this area here. Look, we're in a bullish buy program. It sells off a little bit, but it's only doing what? It's coming right back down into this buy sign of balance, sell sign of efficiency. Well, how is that one? Like, what's going on here? It's blending two things. Number one, this level was a bearish fair value gap here. Then when we crossed over it there, this changes its first utilization to now inversion fair value gap. So it's going to support price if the market's bullish. Bodies are not touching it. Wicks are touching it. And we have this buy sign of balance, sell sign of efficiency. Both are anchored to what? The lower quadrant of the blue shaded area. That's the suspension block on the daily chart. Once you have your daily chart mapped out appropriately and what key PD arrays are there, notice I have an entire universe, a smorgasbord, okay? It's like a all-you-can-eat banquet in front of me. I can buy and sell all day long using this stuff. Bullish fair value gap, inversion fair value gap, blended together. Stops dead right there. And it rallies up, and here you go. It starts generating all this consolidation in here. Going into what? The afternoon session. So it's building an area where retail is going to see that as what? Resistance. Well, resistance is futile. The market comes back down. The bodies can't even look at it. Look, 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 look. Is that body right there? Is that body touching the inefficiency here? No. Does it wick into it and react off of it? Yes. So if it's bullish and we see these signatures here, do we anticipate the market going higher or lower? Higher. What should it aim for? Relative equal highs. So it should bust through this like SWAT. Rally. Come back down in. Rally. Here you go. We have a wick. Okay. This wick, you grade that, split it in half. Wick. Consequent encroachment. If it's bullish, the bodies are not allowed to breach it. You shall not pass. What's it doing there? Look at that. If it does that, and then we open up here, we trade down to the wick, that's a perfect buy. Anything in here to here is perfect. But this is a bonus down here. Well, how do you know it's not going to go going down here? Where is it at? What's this level? That's the lower quadrant of the daily suspension block. We're going higher. Everything is indicating it's going to go higher. Rallies up. What is this right here? This is just me using this inefficiency right here. Okay. There's your key level. That's part of all this range. Okay. So what I'm looking at, we're inside of all this right here. See that? We're at that key level. Market trades down to this wick, consequent encroachment, and it's half of this inefficiency. Okay, that's an inversion fair value gap, but now it's going back to what? First utilization. So it would look like this now if it was following the color schemes that I use when I'm teaching. There. So we're in the upper half, but we have this wick. That's why it's allowed to put that close below halfway point. You have to be able to measure these things. And it's confirming that it wants to go higher. Then it goes higher. Rips straight out the gate, all the way up, piercing higher, higher, higher. And then we enter into a retracement back down into that same order block right here. We're using the wick, high, and the opening. That's a nice little sweet spot. Why is this an order block? Because it's laying on an octant. Trades down perfectly to the order block there, rallies up, comes right back down, touches the key level again, part of that inefficiency, rallies higher. Market rallies. It's in the upper half of this buy side and balance sell side inefficiency. There is a key upper quadrant level, rallies up. It starts getting a little disorganized in here, but that's okay because they're just painfully crushing everybody that wants to be shorting it. Relative equal highs here. We trade down in here, and this buy side and balance sell side inefficiency. Working inside that, here's consequent encroachment of this inefficiency. And we have another little fair value gap right there. Right there. And then we use it there, rallies up, supports it here, goes higher, and there we are at the high of the suspension block on the daily chart, trades back down in, and then there's where we're at now. Now think, folks, logic is absolutely there. It's absolutely there. Small little buy side and balance, sell side inefficiency that wasn't on the chart when I was beginning this video. Gap. It's touching this upper octant, that level right there. So we take this and this, draw it out. If it's bullish, it won't touch or put a body below the midpoint. Look at it. It can't even put a body on the upper top of it. Come down, doesn't even touch it. Gets real close to it right there. Watch. See, small low separation. This candlestick's low. Look at it. 32. It's one tick above. It can't touch it. Is that bullish or is it bearish? Bullish. There you go. And then there's where we're at now. I really want you to appreciate what's going on here. Look at that. It's real hard to figure it out when you look at it that way, isn't it? I can't tell you how many times I cried, weeping, 20 minutes before I had to leave to go to work, hating life, hating everything that was going on around me because I blamed these things here that they were hurting me. These candles can't hurt you unless you give them the weapons to do so. Think about it. But when you say, I'm going to make friends with you, I'm going to align with what it is you're doing because I can't change what you're doing. The buying and selling pressure of all of us collectively isn't going to influence it. It's going to do what it's going to do because it's scripted. So what are you best suited in doing? Aligning yourself with what the market's going to do. And don't resist it. And learn the language I'm giving you because it's the source code. It is the very thing that makes these markets behave and go where they're supposed to go. Does that mean you're going to be right all the time? No. But what if you're right half the time and you don't over leverage and you don't abandon the model and you use sound money management? You could change your entire family tree financially, not just remove yourself from the necessity of having a job. That could happen. But you could also build generational wealth that none of you even can fathom right now. You don't find it with competitions. You don't find it with trying to be on leaderboards. You don't find it by being the most loved online influencer. You find it by staying in your lane, focusing on what you're trying to do every single day, and allowing nothing to distract you. No one else's opinion, nothing can thwart your approach to pursuing it, and it's yours. You deserve it. If you're going to put the work in to learn this, then you deserve it. If you don't want to work for it, you don't deserve it. And I don't feel sorry for you when you complain. Because I already told you in the beginning, it's going to be hard. I told you it's going to take you more time than you want it to. And there is no shortcut. And when you live life with the idea in your mind that there's no plan B, I'm burning the ships, I'm not going back, this is where I'm going to go. Nothing's deterring me, nothing's turning me around.